The financial architecture of debt recovery. Welcome to the deepest dive into utility tariffs available to the public. What if the long-term debt built into your rates has already been financially recovered by the utility? This is the heart of the double monetization issue. This systematic double charging is facilitated by two powerful financial and linguistic tricks, and neither works without the other. Trick 1 is non-transparent tariff language, which defines your mandated payments as general revenue, not a direct debt offset. Trick 2 is debt securitization, where the utility sells your future payments as a financial product on the secondary market while simultaneously recovering the same cost from you directly through your bill. Let's define the ultimate financial manipulation using an example like PG&E's wildfire debt or Del Oro Water's infrastructure loans. The liability, a massive long-term cost. The debt obligation is incurred, e.g. $6 billion in wildfire claims per CPUC decisions like D21-08022. The securitization. The utility takes the future revenue stream, the money you are obligated to pay for this debt, and packages it into ratepayer-backed bond, often called recovery bonds. This financial product is sold to investors on the secondary market. This immediately provides the utility with cash today, allowing them to pay off a short-term liability. The tariff charge. Simultaneously, the utility approaches the CPUC for approval to add a specific fixed recovery charge or rate component, like a specific sub-account fee in your general rate case, to your monthly bill to recover those same costs. The double dip. The utility gets cash from investors, the bond sale, and cash from you, the tariff charge. The non-transparent tariff wording ensures that your direct payments do not automatically offset the principal of the debt that was just packaged and sold. The utility and its financial partners profit on both sides. 2. Decoding the linguistic and accounting traps. The core of the problem lies in the legalese. These tariffs are designed for plausible deniability. You must locate the difference between money defined as general revenue and money defined as a direct principal offset. The problematic wording. Tariffs often define payments simply as a component of the revenue requirement, or to track the difference between authorized and actual costs, as seen in sections of the Core Fixed Cost Account, CFCA, in PG&E's Preliminary Statement F, see advice letters like 5044G. The requirement. To prevent the double dip, the tariff must explicitly state that the funds collected from the ratepayer fee are automatically registered as a credit entry to immediately reduce the principal balance of the corresponding securitized debt obligation. The absence of this transparent dollar-for-dollar offset language is the first key to proving the non-transparent scheme. For gas customers, we find a specific financial drain in the cross-referencing between a rate schedule and the gas balancing service, GBAL. The Schedule GBAL generates revenue through cash-out charges, penalties for usage imbalances. If this penalty revenue, generated from ratepayers, is not explicitly listed as a credit entry in the Preliminary Statement CFCA accounting procedure, that revenue can be collected without offsetting the core distribution or infrastructure cost debt. The utility recovers the infrastructure cost from your monthly CFCA rate and then collects the GBAL penalty revenue without having to reduce the debt balance, achieving the double recovery. This is a crucial area to audit. 3. The regulatory overreach and legal statutes. This entire scheme requires regulatory permission. The CPUC is mandated by state law to ensure just and reasonable rates. The statute, California Public Utilities Code, S. 451, states, all charges demanded or received by any public utility, for any product or commodity furnished or to be furnished, or any service rendered or to be rendered, shall be just and reasonable. The allegation, allowing a financial structure where the utility is authorized to recover the same costs through two independent, non-offsetting mechanisms, one through securitization and one through a direct tariff fee, constitutes an alleged violation of Public Utilities Code, S. 451, and the foundational principles of cost-based rate-making. The non-transparent language facilitates this exploitation. 4. The document demand. your audit checklist. To uncover and halt this scheme, you must use the utility's own regulatory language against them. Copy this list and demand these documents from the utility and the CPUC's Public Advocate's Office. Securitization financing orders and filings. Goal: to prove the debt was financialized. Ask for all CPUC financing orders and applications related to any securitization bonds, recovery bonds, that contain the specific debt obligation you suspect is being double-charged, e.g., specific wildfire debt tranches or infrastructure loans. Reference decisions like D21-0802 or relevant Del Oro water resolutions like W5245 for the SRF surcharge. Tariff advice letters and resolutions. Goal: to find the non-transparent language. Ask for the specific advice letters and resolutions that approved the tariff components, the rate fee, tied to the same debt obligation identified in the securitization filings. Focus on the language within Preliminary Statement F, Section 6, Accounting Procedure. General Rate Case, GRC. Revenue Requirement. Filings. Goal: to track the accounting treatment. Ask for the utility's most recent GRC revenue requirement filings detailing the accounting treatment of securitized debts versus direct ratepayer contributions for the specific cost in question. Proof of principal offset documentation. Goal: the ultimate proof of double charging. Demand: documentation that clearly shows how ratepayer funds collected from the tariff fee directly offset the principal balances of the corresponding financialized debt obligation or securitization bond. Demand the monthly and annual credit entries to the relevant debt principal ledger. If they cannot provide this, the offset is likely not happening. The language is there to be found. You just need to know where to look. Use these references, empower yourself, and let us know what you find. Final liability. Disclaimer: this content is provided solely for educational and informational purposes. It does not constitute legal, financial, or professional advice. Fuck rats. Productions and its affiliates are not liable for any actions, omissions, damages, or losses resulting from the use or misuse of this information or the provided template letter. Always consult with qualified legal counsel before pursuing any formal action. Use this template at your own risk.